Hey everyone, welcome to the Proving Ground Review. We got about 5 more minutes and we're going to get started. In the meantime, if you have any questions, feel free to chat in. I do have the chat open for those of you guys that are mastermind members. I've got the chat open from the mastermind site. And then for those of you that are using the link through Webinar Jam, I've also got that open as well. So if you guys have any questions, feel free to chat those in and I should be able to capture those regardless of where you chat them. We're gonna do some old school review today. Day one stuff. We have a lot of new people, and because of that, we're getting a lot of questions that about patterns that we haven't talked about for a while, because early on we talked about them pretty often. And so we're going to kind of review those because these people weren't around in the times where we talked about them so often. So this is for the new folks. Besides, this is the review, and that's what we do. We review in the review. Oldie but goodie. All right. A few more minutes, guys, and we'll get started.
How do we join Mastermind?
Right now we're running a promotion, so you'll go to, let me mute this real quick.
Don't let them know.
Don't, yeah, let's, actually I'm going to change it after because I've given it out too much, but you'll go to daytradesmart.com/members, MEMBERS/promo. And at the top of it, it says, please don't share this link. It's not provided to everyone. And now it's on a recording and a Proving Ground Review, so everyone's got it. So normally it's $200. After December, so we had a beta when we first started the mastermind. We had a beta launch, which was in December. So we introduced it like the end of November and through December. And anybody that participated in the beta launch got in and got grandfathered in as legacy members for $100, or they can pay annually for $1,000. So a lot of folks just paid annually, and then we have others that still pay month to month, and they're legacy members, so their price is going to be $100. The caveat was that if you waited till after December, the price was going to go up $1,000 a year. And so we had this huge influx of people hitting the site as soon as I announced it. Literally the week that we launched on it, and the 2 hours on Wednesday, which, by the way, guys, Matt Parton can't be here tonight, so you're stuck with me for 2 hours. Sorry to spring that on you. So many people hit my site, and I didn't really have my site that developed. Everybody thinks their stuff is cool, you know, but apparently everyone else thought my stuff was cool too. So they hit the site and it crashed my site. So I had to create all this redundancy and stuff, and everything was just a mess in the beginning. We have technical issues just like everyone else does, but it gets better and better. But in the beginning, it was like every other day there was something going wrong, you know, because there's just this huge influx of people that were participating. And at first we were sending text messages and emails to individuals for alerts. And texting companies started spamming us, because instead of just sending it directly to text, so you wouldn't be charged per text through Green Chart, and we wouldn't be charged, which would cause for us to have to increase your price. We sent it via SMS. So there's a way that you can send yourself a text through email. So if I emailed myself my cell phone and I put in my phone number 888-888-8888 at vzwpicks.com, it will send that email to my text message, and it's free. So we were trying to cut corners there, and cell phone companies started spamming us and not forwarding over the text. And then we were sending them through email, and email companies started doing the same thing, like Google and Bing, Yahoo. They started spamming our stuff, so it wasn't working. And so we had to spend some pretty big dollars to make some stuff happen. Our tech ninjas pulled through for us, and they developed a program that communicates with Sierra Chart and then reads the pattern and then communicates with Slack, which doesn't happen naturally, by the way. It's a difficult thing to do, and we'll post it in Slack for us. So every time and then they even got it to a point where within 15 minutes of the top of the hour, if the pattern and any patterns that were there within the currency pairs that we trade, it would send off that alert. And so that's what's currently happening. Because before, especially with flat tops, we had the alerts trigger as soon as they started to form in the market. And so as soon as the hour would roll over, you'd get a flat top right at 12 o'clock. And some people had a 1 minute delay, other people had a 10-second delay. So they're like, was I supposed to take that now, or am I supposed to take that in an hour? And it just seems unreasonable to have to wait an hour. And I'm like, are you kidding me? We're sending you an alert to take a trade that's 90+%. You have to wait an hour. Boo-hoo. Right? But I got it, because I mean, I still struggle with it coming in 15 minutes and remembering to place the trade sometimes. So I get it. But we tightened it up, and so now they've got it to the point where within 15 minutes, whatever patterns are there, you'll get alerted for, which gives you time to analyze and take a personal evaluation and place the trade, which is because we don't want to acquire our Series 6, 7, 11, 22, all these series licensings so that we could tell you to take a trade. There has to be a personal evaluation and then a physical action on your part to enter the trade. That's the law. And I don't want to dance around and work in any gray areas. So we're very, very specific about what we do, which is why everyone has to sign a disclaimer before participating with the alerts. It says these are for educational purposes only, blah, blah, so on and so forth, because we want to make sure that we're adhering to the law, which is why we'll never have an alert that is at the very top of the hour, because that's basically us telling you place the trade, because there's no evaluation that you could actually take within any reasonable amount of time. Hey, John, good evening. And we'll never automate it. So it's not ever going to be anything that will just automatically, create a bot that will automatically place the trades for you. Mainly because just the whole thought of that disgusts me. I want to create day traders. I don't want to create, I'm not a programmer, and we're not a programming software company. We're a trading education firm, and we take pride in educating people how to do things. Besides that, all bots have shelf lives for a number of reasons. No matter how well they work, it's just a matter of time. If there's enough people, let's just say, for example, you have 10 million traders, right? That are placing trades in a 5-hour block, right? There's millions and millions. There's more than 10 million, millions and millions. But let's just say 10 million traders. And you have 1 million of them placing a trade at the very same time. It's not them, it's a bot. But this bot has 1 million subscribers. So there's 1 million separate accounts placing a trade at the exact same moment. It's just a matter of time before the big dogs, the large institutional banks, pick up on that algorithm and start sandbagging them. That's why there's a shelf life on bots. Patterns aren't going to be the same, because you guys aren't all going to take the same patterns all the time. Some of you are going to pass on them. Others are just, and even if every single member within our entire organization took every single alert trade every time it happened, we're not large enough that we would even make a blip on the market, that we would even have to be sandbagged. So and besides that, not everyone's going to press the button at the very millisecond, right? And those things are being tracked. So there's a number of things that that these large institutions look for when they're looking to sandbag people. And so, that being said, that's just another reason why we'll never step into that arena. Nonetheless, it's a great product. It works phenomenal. We just had a report from one of our guys, what was it, 2 days ago? He said, yeah, I've taken like 76 of them, and I have 0 losers. And he says, but in back testing, and I'm like, oh, here it comes. And he's like, I've taken more than double that, and technically I had 2 losers because I was replaying, and I was replaying too fast, and I would have put in the trade too late. But had I put it in at the post, it would have filled. So I was like, all right, well, that's cool. So he's like, he's just all, giddy over it. And then we've got guys that are taking flat tops for they're not taking all the flat tops, but when they take the flat tops, they're knocking down like 50. We had one guy that knocked down 175 pips on a flat top. That was his entry, and he just trailed it. So what he did was he was going to take 30, and he realized the line that he was taking it to was a major support level. And so he's like, well, if it posts, I'm going to remove my take profit. And when it gets down there, I'm going to set a 10 pip stop profit. So if it comes back, it'll give me 10 pips and I don't ever go upside down and I get my 10 pips and I'm happy because it's a 3 pip trade. So it broke below that line. And so he left his 10 pip stop profit in, went to bed, woke up the next morning. And when he woke up, the market had dropped like 200 pips and come back to about 25 pips higher. So 175 pips. And he's like, oh, wow, well, I'm going to take profit. So knocked down 175 pips in his sleep. So that's pretty cool, you know, and we get reports like that all the time. It's cool stuff. And I'm sure you guys have experienced a lot of that stuff too. So it's exciting. So again, we're going to go over some stuff today that used to be just in heavy rotation. But as we grow, we end up with members that aren't as familiar with some of these patterns because they're new. So as part of the review, we want to review old patterns, right? Man, the one that we're testing right now. So by the way, in case you guys don't know, the gentleman in the back, Tim Copeland, if you can raise your hand or stand up, Tim. This is my partner, co-owner of Day Trade Smart. We are founders of the Proving Ground Mastermind. We've done all of this together. I'm just a face man, so you guys get to see me all the time and I get to take all the credit. But Tim has just as much to do with this as I do. And the pattern that he just created that we're going to be rolling out, we are in the process of testing right now. And there's this red zone. And once you pass that threshold, you're almost certain to be above 90%. Well, as we pass this threshold, we're at 96%. And it happens like 3 or 4 times a day for a 5. Say again? Beta tester? we already went through that stage. we actually what we do is we do a lot of the preliminary testing before we have our ninjas go and program it and then run it through, and then it's just a push of a button. So we'll go through a certain amount of winners versus losers, and once we get to that number where we feel like we've passed the threshold, then we pass it on to them, and literally it takes them 10 minutes to program it and then push a button, and it gives us a back test for as far back as we want to go. And it'll tell us where the recommended take profit is, and then we do a 5-to-1 as long as it's over 90%. Yes, sir.
How do you get signed up for this?
It's the mastermind. So you go to daytradesmart.com/members/promo, and right now that's the promo page where we're doing 50% off. You have to be an upgraded member. Are you upgraded to one of the coaching packages?
Yeah.
Excellent. So you go right ahead, sir.
So what would I Google? That's a long URL.
Probably can't Google it. Not that site. Well, not that page.
On Google to sniff it out.
Yeah.
Repeat it, please?
Yes, sir. That's daytradesmart.com/members, MEMBERS/promo. Grrr! This thing went 10 pips. Come on. Messing with my emotions. All right, no emotions. Actually, that's not the case for me.
That's gonna go against you.
I don't. How long have I been in this? It's 6 o'clock right now. I've been in this since 3. Well, I'm not gonna do it in front of you guys, but this is my personal trade. I'd have been out last hour. Yeah, I would have already closed it. I would have had 9 pips and been fine. I don't know, waiting 3 hours for a 10 pip trade. Get out of your mind. Anyway, such is life. All right. John, focus. All right. So it's blurry. Is anyone else online getting a blurry screen? Let's see.
I try to do the link, it's all blurry, so I gotta go into YouTube.
So,
So it not be blurry.
John, are you on daytradesmart.com? Okay, David, it was, but better now. Okay, Joshua says my screen is perfect. Dan, yes. Does that mean it's blurry? I got a recommendation from a gentleman in the audience here. He said that usually if you want to see it clear, just go to YouTube and watch the live stream. And the live stream also, John, your mastermind, so you can go to daytradesmart.com and just go into the webinar live, So this page right here, and press play. And let's see if that's fuzzy. Yeah, that is still kind of fuzzy, isn't it? Yeah, still kind of fuzzy. So let's try this. YouTube. Sure. Slash the proving ground. How do you do this? Let's see. Where's the live feed? See, this is why I have ninjas. They do this stuff for me. So I can just pretend that I'm tech savvy. They make me look good. Okay, Amy's saying was better now. Okay, good. All right, awesome. Awesome, John. Let me know if it's better when you go to youtube.com/the proving ground. It could be because I'm logged in that I don't have the option for the live feed. Nonetheless, that would be the two options. Go to the site, daytradesmart.com, and go to webinar live, or go to the proving ground, youtube.com/the proving ground to our YouTube channel. And as you guys can see, this used to have a ton of videos, and now it's got nothing because it's all on the Day Trade Smart site. But I mean, we have tons and tons and tons of content. All right. Let me make sure I don't have this playing. Good. Okay. Let's go to calculator. All right. Okay. Yep, that's right, John. They're absolutely useful. Only goes to gray screen. Dan, are you using the one that's for Mastermind or for the Proving Ground Review? So you should be getting one that goes to Proving Ground Review, and that's actually the one that I'm using. Is at the top when you're logged in. That's correct, Dan. Yep. So go to daytradesmart.com, log in, and use the webinar live tab right there, and you'll be able to. Well, since you're chatting right here, I think that's where you are. It's the only way you can chat, unless you're on YouTube directly. Okay. All right. So hopefully that works, guys. We're going to move on.
Byron,
Yes, sir.
I'm signing up right now.
Okay.
Promo code?
Are you on promo? It should give you the $100 price. Is that what it's, and the $1,000 for a year?
Yeah, then you click enroll.
Yep. Click enroll in whichever option you want. And the block pricing is for COD, so they can pay for membership for members that are upgrading as a promo. And that's what that page is for.
Enter promo code.
Oh, you don't have to. Yeah. Yeah. If you had one. Yeah. Thanks for that, Sam. Sam, I don't know that anybody else can. I guess that was for me. So, but thank you. All right. Awesome. So we're going to talk about the HICCUP and pretty much anything else you guys want to talk about tonight. So we're going to talk about HICCUP and HEADFAKE tonight. And I want to elaborate on a couple of things with the HICCUP and HEADFAKE.
Since you said the people are new, the starting time is 2,110 seconds, right?
Yes, that's right. 2,110 seconds. Matter of fact, I had a gentleman that asked about the video that we had for setup, and he said it was a little blurry. Seems to be a recurring issue. So I created a new one today, threw it together, edited it, and here it is. Mastermind green chart settings. So this goes over the time settings. So for spring, 2,110 seconds, 210010 versus 210100, and then 2,100 flat for the end time. And then in the fall, it's 2,210 seconds and 2,200 flat for end time. And then it goes over putting the thick orange value on your TNT so you can identify flat tops. It goes over chart calculator tool, goes over the daily versus 1 day chart and the weekly versus 7-day chart. So it goes over all of that stuff. And it's only about 14 minutes long, so it's not long. I crammed a lot in there. Matter of fact, it was like 25 minutes before editing, and then I cut out a good 10 minutes. So there it is for you guys, for those of you guys that have access.
So when I said, is this just in my account, access to these?
So once you enroll, you're going to have it's going to take you through a process. So once your payment is done, it's going to take you to another page. It should redirect you to another page that's daytradesmart.com/enroll, and it's going to have a form that you fill out and alerts disclaimer. And once you've got those done, it's going to trigger for Slack to send you an email saying join our Slack channel, and you'll use that to join and register with Slack. But it's also going to give you login so that you can access daytradesmart.com. Let me know if it doesn't do that. Awesome. Good to know, Dan. Thank you for that. And okay. Is what in Russian, John? All right. So for those of you guys that are not aware or don't know about the oh, retry can read in English now. Okay. All right. The HICCUP is actually our flagship. We started with that one. What were we counting, Tim? It was like 3 years ago. 3 years ago, we started with the HICCUP pattern. And the reason why we started with the HICCUP pattern was because we were getting a number of our members coming into us, and we were helping them, you know, as they're progressing and coaching. And, you know, some of them start running into issues with indicators and things like that as they start to learn and grow with indicators. And part of the issue that we're having was that they were taking trades in opposite directions than we would have taken them. And so it became this challenge for my partner and I to figure out why they think that they could buy or sell in certain situations. So we realized that there were things that we were seeing that we weren't necessarily conveying to them, to you guys. And so what we did is we created patterns that gave you insight as to some of the nuances within the indicators so that you can keep yourself out of those troubled situations. And for a long time, the proving ground was all we had. We didn't have the mastermind, and we didn't charge anything for it. And we started in the other conference room, and there was just about 4 or 5 of us that kind of got together. It just kind of became a thing. And as we got going, other people wanted to come in, and so we allowed other people to start coming in. And eventually it got to a point where we couldn't do it in there anymore. We had to do it in here. And then when we started doing it in here, word got out, and people that were not in the state wanted to attend, which is why we started casting it online, and it was free. Well, we made a decision a long time ago that the business was going to support itself, that we weren't going to take from personal money and put it into the business. And the proving ground was the exception that I was kind of making, right? So it's kind of like my little secret, you know, it was my dirty little secret. And I was like, okay, well, this is really starting to cost me like time and money to do this little hobby on the side, but I'm just going to kind of keep it under wraps. And then it got so big that the secret was out. And so I had to have a hard conversation. Tim's pretty good about having that conversation. Matter of fact, Kevin Jones tells me, you're like a freight train. He says, nobody wants to get in your way because you're like a bulldog, right? And so he's like, does anyone ever tell you no? And I'm like, yeah. He's like, who? Tim? Oh. So, yeah, my partner keeps me in check. Anyway, so, you know, we had to have that conversation. We realized, okay, so we're expending too much. It's not paying for itself. So we're going to go to figure out how we can monetize it. And so our first idea was to use YouTube, and that's why we created the Proving Ground site on YouTube. And it was a great idea at first and in theory, but you had to hit certain metrics in order to start monetizing and have ads run on your site so that you can get paid. And if you can get paid to do that, then one hand washes the other, nobody gets charged. And, you know, I feel like it's supporting itself. Well, as soon as we hit the benchmark, so I went out and I was like, everybody subscribe to my YouTube channel. I don't care if you ever watch it again, just subscribe because I need the subscribers, and then click on some stuff so that I can get the views. So you need subscribers and views. And so we got to that benchmark where it's like, okay, you need this many subscribers and this many views. And once you get there, then you can monetize and all is right in the world and champagne showers and, you know, everyone's happy, right? And so as soon as we got there, yeah, that's right. Red definitely tells me no, John. As soon as we got to that point, YouTube updated their policy and like tripled the requirement. I was like, holy cow, man, we were almost there. So we decided, okay, well, we're just going to have to monetize it by charging for it. And if people think it's worth it, then they'll pay for it. So we had this notion that, okay, there are some things that we've been kind of holding on to just in case we needed them to entice people to pay for the mastermind. It was not alerts, by the way, it was flashcards. Of all things, the number one thing people were asking for were flashcards. They wanted these things that they could see, you know, that would explain the pattern step by step. And so we have those, right? We created them since. And, you know, it's pretty basic. It shows you an example of, say, a flat top oversold. So flat, -100, major, minor oversold. And then it takes you line by line, thick orange, thin orange, blue dotted, thick blue, red major, green major, so on and so forth. Even the candle, if the candle is same or opposite. And then in the end, it tells you to buy and then for how much, right? And so that was a big selling point for us. And so we developed that. And we had a couple other things we were going to throw into the pot to kind of sweeten the deal. And right about that point, we were introduced by one of the members to this way of creating a personal alert that would kind of chime for you when one of the parameters were present. And so we became really enthralled with this, and we started digging in and trying to figure out, okay, how can we get all of our patterns on this, and then we can just share this with people, and so that way they can get a chime on their green chart whenever there's an alert, which, by the way, still would include you sitting in front of your computer or being within earshot of your indicators in order to get the chime, because it would have to come from your computer. But we were really like intrigued by this whole idea, and like within a week, preparation met opportunity, and all of a sudden we started meeting other people that, as a matter of fact, Adam McKinley and I went to church a couple of years ago at the same church. He's since moved out of the area and goes to another church, but I knew him and he became a member, not my member, because I didn't really talk to anybody about, you know, that at that time, but he became a member, and he just so happened to be here his second time coming out. And I was discussing these alerts in my office with a gentleman, and he says, "Oh, what are you guys trying to do? What are you guys up to?" And I explained it to him. And he says, I said, "You know what would be cool is if there was a way we could send out like a text message or email when this happens." And he says, "Oh yeah, I can do that." And I'm like, "What? What do you mean you can just do that?" He's like, "Yeah, it's simple." "What do you mean it's simple? We've been like toying around with this for like a week." So anyway, I asked him, and mind you, this is like, if you guys know anything about programming, there's like programmers, and then there's developers, and then there's engineers, right? And software engineers, within software engineers, there's a hierarchy, right? And so there's like, let's just put it in terms of college. There's like, you know, an associate's, there's a bachelor's, a master's, and then there's like this whole other level of graduates, right? So Adam is the graduate's level of software developer. So he's all those things, right? He's a software engineer, developer, programmer. The guy is just a ninja, right? And that's why I call him a ninja. And Scott is just under that, right? And so at first we had Scott, and we were like, "Man, Scott, you're incredible, right? You talk way above our head. We're really impressed by you because you use words that we don't understand," you know. And so Scott kind of pointed out to us at one point, "Okay, the way I am for you guys, that's what Adam is to me." And we're like, "Whoa, he's that good," you know, because we were like just enthralled by Scott. And so anyway, these two, we were able to bring them into our team, and they're the ones that are responsible for all the development in the software and integrations between GreenChart and Slack and just about everything else. Now they're into like reconstructing our site. We've got a new onboarding process where, for most of you guys, how many of you guys were onboarded where somebody called you or you were on a webinar and they walked you step by step how to download GreenChart, how to download? Now tell me this, in any other situation, whenever you're talking to someone and they're walking you through a tech support thing like that, there's usually something broken, right? It's not because everything's going as it should. It's because, well, something's broken, so I got to call a technician, and they're usually pretty condescending. So the first question they ask you is the computer on? Is it plugged? Yeah. Yeah, that's right. It's right there, right? It's scripted. Is the computer on, right? Is it plugged into a wall? Is your electric bill paid? So, we realized that was creating a bottleneck within our organization and just kind of threw it out there. So every once in a while, Tim and I will sit around and we'll say, I wonder if we could do this. What would be cool if we just push one button and it would just automatically download Green Chart with all of our settings. Oh, and Tim's like, oh, and TeamViewer, let's put TeamViewer, because if they can't download something, then at least we can see their screen and help them troubleshoot it. Oh, let's not forget about Capital City Markets, because if we can get that on there, then we won't have to worry about any of these downloads. And Adam and Scott sit there and they say, challenge accepted. We can do it. So, within a day or two, they've got this button for us. And now that's how we do onboardings. I mean, we send somebody a link, they push a button, it downloads everything for them. It's awesome. Yeah, serious. Yeah, these ninjas.
So what you're saying is, I'm going to be going through that.
No, you already have Green Chart, right?
Yeah.
Yeah, you're set. But what you'll do is all the legal stuff, right? You got to just register so you can log into daytradesmart.com, and you got to accept the disclaimers for the alerts.
Mastermind chart.
Oh yeah, well, actually, it's gotten to the point now, because everyone has Green Chart, that you can go in right now, go to File, go to Open Chart Book, and we'll just search for it. There it is, Mastermind Chart. So it's already there. If you're with Day Trade Smart, we're CODs as well, so we bring people into the organization as well. So when we bring in our people, that's the onboarding process they go through. The girls never do our onboardings. We do our own, but it's easier for us now, so no complaint. Anyhow, so all these things happen within a matter of a week. What's that?
I didn't even know that was there.
Oh,
I just opened it.
all these things happen within a matter of a week. They just all kind of culminated, came together. And so that's when we decided, okay, we want to call this thing the mastermind, because it's kind of it's a collaboration, right? So I'm not the mastermind, my partner's not the mastermind. Together, collectively, we're all the mastermind. And that's kind of how we coined the phrase. But then there was real value, right? So it's like, well, now we got something really awesome. We've proven these patterns. Now we just need somebody to beta test them to make sure that when we alert them that they're actually there the way they're supposed to be alerted. And we want people to take the trades, so we can see that they're working out. So we want to front test this to make sure that they're actually seeing the patterns, and what they're seeing, they're understanding, and they're placing the trades. And so we had this whole reporting process. So in order to be part of the beta, you had to pay us. Check this out, genius. No, you had to pay us to test our products. No, in all seriousness, it was really cool and exciting for everyone. But and it basically pays for itself. So it's not like there's like this big profit, margin or anything. But anyway, so now we're not just peddling flashcards. We had these alerts. And so once we rolled that out, and we rolled out the beta, and we gave the promotion for people to participate in the beta, it just exploded. Everybody wanted to be a part of it. And there was a lot of skepticism in the beginning until so what we did is all the reports were posted on a Google Share Doc. And so if you were going to report, you had to create a tab for yourself and then put the trades that you put in, the time, and so on and so forth. And so as soon as people started posting those, all of a sudden it was like there was like this fire that was lit, and people were like, this is incredible. They were hitting 20, 30, winners before even hitting a loser, And so it was just explosive, and it continues to be that way. We've kind of backed off on rolling out new patterns because we've tried to change our focus a little bit to more day trading disciplines, like what we did with the 5-part series, because that's invaluable. If the alerts ever go away or whatever it may be, you're a professional day trader, just like if you were a welder. You know, you have something that you know how to do and nobody can take away from you. And that's what we want to empower you with. So not something that creates codependence on us. And again, the alerts are just to give you insight as to how the indicators work. They're not to make you reliant on us. My hope is that most people get to a point where they either quit the alerts because they don't need them because they can read the indicators proficiently enough, or they only subscribe to alerts because they're out living their life and not having to work a 9-to-5 job, right? And so you have time freedom. When you have time freedom, you don't want to sit in front of a computer and trade. So it's nice to get an alert to tell you when it's time to trade. So that's my vision. That's my goal. Yes, sir. You had a question? Yep.
These charts, there's 6 of them there. Are those the main 6? Are those the 6 pairs that you mainly trade in?
Those are the 6 pairs. The 6 charts in the mastermind chart are the 6 pairs that we alert for. We used to have USD Swiss franc was a new addition, but we had GU, I think, GBP USD. No, Aussie, GBP AUD, and the spread was heinous. So the Aussie pairs are usually pretty bad. Aussie CAD right now. Oh, yay! It quit messing around with me and it got out. Oh, both of them did. Okay. Let's see. So these were duck bills. I'll show you guys these in a second. Rip off. 36.59. Okay. The G Aussie right now is 3.8 pips spread, 4 pips. And the Aussie CAD, Australian dollar Canadian, is 3.1. So when we back test these, we call it the proving ground because the proving ground is January 2015 to current, whatever current is. And that time frame is what we refer to as the proving ground. And the reason for that is because just about any market condition that's happened has happened within that time frame. So in order to prove a pattern, we go to 2015, January 2015, and we test forward. Mind you, it's a 60-minute chart, so it's 60 minutes at a time. So when we first did this before our ninjas, it was taking us about 70 hours on average per currency, per pattern, and 2 out of 3 failed because they didn't hit a 90+% accuracy, having no less than 2 variables and no more than 6 variables. And they had to hit 90+% with a 5-to-1 ratio, meaning your stop loss is going to be 5 times your take profit. But at 90%, the math works out, right? So if you took 9 out of 10 trades for 3 pips, you have 27 pips. If you took one loser at 15 pips, which is 5 times 3, then you would have 15 minus 27, and you would still have 12 pips profit. If you're trading at 0.1, you have $6 commission. So even after that, you have $6 profit, and you walk away with dollars in your pocket. Which I don't know about you guys, but that's kind of the point, right? I'm just making sure it's not about win rate because that's not what it's about.
But we don't do it to lose it.
Yeah, you don't do it to lose it, right? Right, and it's not about win rate. I know some of us get prideful about our win rate, but again, unless Nike's going to come and sponsor you to trade, then you're not going to get paid on your win rate unless it's making you dollars. So making dollars is more important than win rate, although win rate helps. So we back test, and so if we're back testing a 3-pip trade on the Euro US dollar, we're not back testing whether or not the trade goes 3 pips. We're back testing whether or not the trade goes 4.2 or 4.5 pips because we want to account for the variation in spread. So now we're looking at the Aussie CAD, and now we have to have double the movement for a 3-pip trade because of the spread. And sometimes more than double the movement because the variable spread. Sometimes at 3 o'clock, it's going to be 8 pips, which is almost triple the spread. And so although they did test out, most of the patterns did test out, it was just frustrating when you had even just a small variation in the spread that would cause for you to miss the trade. And so, bless you. So because of that, we decided to ditch the G Aussie. Aussie CAD was on its last leg for a little while, but it hasn't really output very many flat tops, which is the only thing that we have triggered on it. But to answer your questions, I know that's kind of long way to answer your question, but these are all just where the alerts happen. So every once in a while, we may cycle them out. So we may get rid of Aussie CAD, but there'll always be at least 6. So If we cycle out Aussie cat, we'll replace it with something. And if we can't replace it with something, we'll leave it as long as it's performing at the level that it needs to, in this case, 90%. Yeah.
These are set at 22 too, so are these daylight savings or not?
Oh, if it's set to 22, it's because we haven't updated. It was there before the time change, but they should all be linked. Let me double check here.
So we should change. We can just change them, right? You want to change that?
You probably just change one of them. And
linked, right?
They should be. Let me double check.
Euro USD, my flat top.
They're all linked.
They are
They are.
by session time.
The link number, session times, yes.
Perfect. Yeah, just change one of them and all of them will change. Change 2100 in 10 seconds and all of them will change. That GU flat top did not go. We didn't get it on the last hour. Remember who was watching that with me?
Yeah, it was.
Or are we still in that same hour? This is the next hour, isn't
No,
it?
it's the next hour.
Yeah,
It
so
was
it's
before 6 o'clock, so it wasn't.
yeah. So we're actually. Did we get alerted for it?
You got one forming on the Euro USD right now.
I guess we wouldn't get alerted for it yet for another 10 minutes or so. And on the EU?
Yep.
Yeah, look at that. Miners are a little, they're close.
It's forming.
Yeah, it'll get there. When it was up there, it was there for sure. So in about 10 minutes, we may get an alert for flat top on the EU and flat top on the GU.
Yep.
All right. Okay, let's go to the HICCUP pattern. Push one button to have all that done. Nice work. Yeah, thanks, John. All right. HICCUP. Where's the HICCUP? I don't see it.
No. Not quite.
Not quite. Okay. All right, here we go. This is the HICCUP. Oh, we're reviewing the HICCUP pattern. Sorry. So this is the HICCUP pattern. And so I've had a number of people ask me about the HICCUP pattern because we kind of allude to it in a lot of our indications, especially with the duckbill that we just had, where the first part of the duckbill hiccups, right? So if we look at the EU duckbill and the UJ duckbill, these are both one-day charts. You can see that right here, we have the duckbill and the USD/JPY. And when I explain the duckbill, I always talk about the hiccup, not HICCUP pattern, but hiccup first. So I'll talk about the hiccup like we see it in the HICCUP pattern. So in explaining this, I had a number of people say, well, what's a HICCUP pattern? So that's why we're going to talk about HICCUP pattern tonight. But it hiccups, and a hiccup, for those of you that don't know, is basically within the lines within the pair disagree. So you can see that the lines within the major, which are the green and red, disagree. The green is down and the red is up. And they're not crossed or touching. That creates a hiccup. Minors can also hiccup. But what's relevant in a hiccup pattern and a duckbill is when the majors overbought create this hiccup, and then on the very next candle, in terms of the duckbill, continue up and create that bill, right? So then it looks like a duck's bill. So it looks like if this is the neck and this is the head of the duck, then this is the bill. There's a little quack right there. There you go. So there's your duck bill. So we got that on the UJ, USD/JPY, and the alert came out at like 6 o'clock yesterday, but it's for 3 o'clock today, right? The end of day. And the Euro USD, we also got one. So you can see here the same thing happened. Hiccup, hiccup, green up, red down on this one, green down, red up on this one. And then this one continued down right there. And this one continued up right there. And so our entry would have been at 3 o'clock. I actually got in a little bit early because I'm like, you know what? I'm going to just, the swap is usually worth it. I'm going to take the smaller spread because generally at 3 o'clock, the spread increases. But if I get in just before 3 o'clock, then I don't have that increase in spread yet, right? And so I get in just before 3 o'clock, and then 3 o'clock rolls over, and my partner's like, man, I got hit with, this many dollars for a swap, And I was like, oh, crap, it's Wednesday. So on Wednesdays, you get 3 times the swap. And so it definitely was not worth the spread to take the 3, the swap times 3 But so you can see right here that we only, this is a demo count. So we played at 0.4 there and 0.4 there. And here is the buy on the Euro USD duck bill. And you can see that we didn't really take a lot of heat. It was just a little bit. And then so you can see I got in before the end of the hour because it ended down there. And then we filled right there. And then the USD JPY, we got in here, took a little bit of heat there, and then filled the trade there. Just now, as a matter of fact, as we were talking a little bit ago. So 20 pips. It took 3 hours and 41 minutes. That's disgusting. Anyway, 20 pips. Okay.
3 hours and 20 minutes.
Yeah. So
It's not the end of the world.
yeah, it's not the end of the world. It's just miserable. So what is that? 76.59. So about $80 for 3 hours. So, you know, $28 an hour.
It's not bad.
And I wasn't really working that hour. I was just mad because it didn't fill in 30 minutes. All right. So again, on a hiccup pattern, we see something similar happen. But versus waiting for that to point down, this is a 60-minute, not a 1 day. We want to see the majors hiccup either overbought or oversold. In this case, they're oversold. Now, again, the reason why we created this is our flagship. We started with this one was because we're noticing that people were taking buys in these situations, similar situations. Because the first thing you learn when you get here is oversold, wait for the double cross up, and what do? Buy, right? So in their minds, not understanding some of the nuances, they're thinking, I'm going to catch it early. It's oversold. It looks like it's going to cross next, right? So if I get in, if it crosses, usually if it crosses, there's a green candle right here, and then I get in over here, and then I go up, right? But if I get in now, then I'll be able to go up from here, right? Wrong. So that's kind of what set us off in this direction, because it's important to understand that the majors are playing against the minors. It's a zero net market. In a zero net market, there has to be losers in order for there to be winners. You can't, the broker's not paying you. Some rich guy, you know, in Dubai is not paying you to win trades. The losers are paying you to win trades. So it's like Hold'em. I don't know if you guys know anything about Texas Hold'em, but the reason why I can have a room like this full of people and we can all play Texas Hold'em right now in Utah, and I wouldn't be breaking any laws. The only caveat is that I can't, as the facilitator, take a rake. In other words, whatever you pay to get into the game, I can't take a piece of that, right? But what you pay is your skill versus someone else's skill, and whoever wins that, the losers basically pay the winners, right? So I'm not, as the orchestrator, I'm not paying you your winnings, nor are you paying me anything to show up. Matter of fact, most people do is bars will do it because guess what? People that play cards like to get liquored up. So it's like, come and play cards and we'll give you drink specials, you know? But so it's similar in the sense that it's not the establishment or the broker that's paying you to win. It's the people that fail to win that you take the money and put it into your pocket. So the majors abide by that same rule. Well, one thing that is not effective to do is for banks to fight against banks in the market with each other's money, because it'd be like a big Fortune 500 company suing another big Fortune 500 company. Neither of them is going to run out of money in court, right? And so they're probably not going to do that. Where if you try to go against the Fortune 500 company, they can pretty much bleed you out and you'll run out of money before they do, and so you'll have to drop the suit, right? And so it's kind of the same concept. So in this particular instance, majors still have to have losers. So how do they create losers so that they can win? Well, one way, which upsets me, is to affect legislation through special interest groups. So hence Dodd-Frank, right? Mm-hmm. You get Dodd-Frank, and Dodd-Frank says, well, To protect the consumer, we're going to cap you at 50-to-1 leverage. We're not going to allow you to hedge. All the things that allow professional day traders to protect their trades long enough to allow the market to breathe, come back and take profit, right? If you remove those things, that just makes it more, it just makes it simpler for banks to push the market even just for a moment in the wrong direction to stop you out of your trade so that it can come back and go in the direction it intended to go, because they need you to lose in order for them to win. So what we do that's different is we don't trade like the miners, mainly because where do you think that the miners get their information on how to trade? From the majors. Big surprise, right? And like Vegas, every once in a while the house has to pay out to keep the players playing. So sometimes you'll notice the market is just super technical. You're like, man, I don't even need indicators right now, right? It's just perfect. And it's going to go to this line and then it's going to go there, and price action is working beautifully. Everything is as it should be in the world. And that's the majors basically saying, okay, reload off of each other. We're going to kind of sit this one out, and we're going to let you guys kind of take money from each other and feel good about things again and get your confidence back and maybe go back to the bank and upload your brokerage again so that we can take more money from you, right? And so then when it's time to, get back into the market and clean house, that was strange. We're possessed here all of a sudden. Then they will come in and they'll take those winnings back, because in that game the house always wins. But what we're doing is we're actually watching as spectators on the sidelines and watching how the majors interact with the minors. And the better we are at watching this game and understanding the nuances and reading the indicators, then the more effective we can be at staying away from some of those bull and bear traps. And so a lot of times when traders are struggling, I find that they're going online, they're finding information, or they're adopting other disciplines that in general traders use, and they conflict with what we do. They conflict because they don't work. So you try to adopt all these other disciplines that you think are going to work because somebody that's a strong name is promoting it, which, by the way, they're probably being paid by the majors to say these things, and that's not uncommon. Shaquille O'Neal has been known to work pump and dumps all the time, right? He's going to promote a product, so people say, "Oh, Shaquille, that's Shaq. I trust that guy. I'm going to buy into that." And then the stock market goes up, and then all the owners dump their stock, and it crashes, and people lose their money. So that it's a common occurrence, but what we're trying to do, what we're successful at doing, is identifying those nuances within the indicators, and the HICCUP pattern is a great example of that. So here, although it may appear as though the majors and minors are going to start rolling and going to the long side, we're actually going to short this, right? And this is actually really indicative of what we see happens commonly within the patterns of the indicators, that understanding kind of how they correlate, how the majors correlate with each other and in comparison to the minors, give us the formidable advantage. If the majors want the minors to think that the market's going up at a certain support level, then they're going to remove trades from their pot, right? They're going to take profit on some trades, remove some lots from the market. And removing those lots is going to cause for the market to go. So if they're in sell trades and they close those sell trades and take that profit, then that alleviates the pressure of sells in the market, which causes for the market to go up, right? So removing sells from the market makes it go up, as well as buying in the market, which is why if you ever notice during announcements, the market will shoot up and then come back down, right? That's because straddle traders are getting in right at the movement, and it's shooting up, and then when they take their profit, all those buys that were in are now gone, so then the market pulls back down. So those two things make the market move either up or down. Buying makes the market move up, and getting out of sell positions make the market move up. Selling and getting out of buy positions make it move down. So if the majors want the minors to believe that the market is going to go up, they don't have to buy. They just have to get out of sell positions enough to cause for the market to alleviate and start moving up. Yes, sir.
why would a trader want to buy that situation? The pressures are strong down.
Yeah, absolutely. The pressure is strong down in the situation because you understand that you're not susceptible to that, but there was a time where you didn't know that. And so it was those times that we wanted to affect people early on so they weren't making bad habits early on or having misconceptions about how the indicators work. So here we have red down, green up, not crossed or touching. That's the first element, and it's oversold. Miners have taken the bait. They're crossed and pointed up, and they're touching the threshold or beyond. In this case, they're just touching it. As David pointed out, the green pressure line, not only are they pointed down, but green is below red, which gives us short-term bias to the short side. And they are also pointed down, which gives us long-term bias. However, it's only necessary to have short-term bias, which means even if these are pointed up, if green is on bottom of red, that is our third indication. Second is miners. Third indication is pressure. Our fourth indication is simple. Contrary candle. In other words, if we're selling, we want to see a green candle. If we're buying, we want to see a red candle. In this case, we are selling, so we want to see a green candle. When we first rolled this one out, it was a 10-pip trade. Since then, the market conditions had changed, and we review our indicators every 3 months, our alerts and patterns every 3 months. And if after 3 months it drops below 90%, we either make an adjustment or we let people know you can't use it anymore at a 90%. Now, because we have the advanced channel, it'll just move to the advanced channel until it can qualify to move up to the TPG channel. Okay, so here we would sell, and it used to be 10 pips, now it's 5. Now, after that, generally what we do is we sell on this candle, and then we usually get a follow-up pattern where majors are crossed and pointed down and minors are crossed and pointed down. And because they're pointed down after the hiccup or any kind of fake out, we actually buy even though they're pointed down. So another point is that these don't work like your standard indicator. Your standard indicator, when it points up, it means buy, and that's the only time you use it. When it points down, it means sell, and that's the only time you use it. Our indicators aren't that way. They're predictive. So they're giving you the lead-in on the candle or a few candles before. So in this case, in the case of the hiccup pattern, it's actually given us 3 different candles. It's given us the sell on the next, and then the one after the sell we'd buy, and the one after that one we'd buy if we have the corresponding follow-up patterns. Now, in this particular case, we actually didn't have the corresponding follow-up on the post. They did come, but they didn't remain till the post. So I'm going to walk you through this, and I'm going to show you an example of where it did remain. One second. Yeah, I went to art school, Craig. That's right. For clarification, only one leg of the miners touching the oversold line enough to meet the touching criteria. Yes, that's correct, Brad. As long as one part of the miner is touching, that's enough. So right here, we're going to short for 5 pips. It used to be 10 pips. We'll short for 5 pips. And there we went 16.5. Majors and minors were pointed down when this wick shadow happened. And because of that, that would have been, had it remained that way, that would have been your trigger to take a buy. And then after that, usually you get a double cross, you buy, and then you get a double cross and you buy again. Now I'll show it to you again in reverse. This is a hiccup pattern overbought. So here you can see green is down, red is up, and they're not crossed or touching. There's a hiccup. Minors are crossed and touching the threshold or beyond. There they're touching the blue. Here they were touching the red. Here green was up, red was down. Here green is down, red is up. So we got 1 and 2. Our third, green is on bottom right here, and now green is on top. They're not really aggressively pointing up, but green is on top, and that's all we need. Short-term bias to the long side. That's our third. Here we had a green candle. Now we have a red candle. That's our fourth indication. So we have all 4 parameters, in which case we would long 5, right? Because if we shorted the other one, we're going to go long on this one. So right here, we're going to go 5 long, and that one went 11.7. So there's our 5 pips long. Now, again, majors are pointed up and minors are pointed up. We're not selling because they're pointed up. We're selling because they're pointed up after the hiccup pattern. That's important to understand. Just because they're pointed up doesn't mean you sell. It's because of what happened prior. So we know that 65 to 70% of the time, the market's still going to go up a little bit. But we know 90+% of the time, we're going to get at least 3 pips to the short side. So if you're stacking your odds, you're going to go with the short, not the long. And so here you end up getting drawdown. Now, obviously, if you position, you're going to get you're in better shape. But if you don't know about positioning or anything else, then you're just going to take the trade, and there's your fill. Now, generally after that, like we saw before, we had a double cross, but we don't have a double cross yet. Majors are crossed, minors are not. And right here now we do. So then we'd short again for 3 more pips. And there it is right there. So, you know, what is that? 11 pips. It used to be 16. All right. So those are the hiccup patterns. I'm going to leave off with that for just a moment. We're going to take about a 5-minute break, guys. So go ahead and feel free to get up, use the restroom, get a drink. If for those of you that don't want to hear me gas for another hour, you probably don't want to come back because you're stuck with me. All right, guys. We'll see you in a sec. Those of you guys that are online, if you guys have any questions in the meantime, feel free to chat them in.
Might have a live one. USD, CHF.
UC flat. So GU is still flat.
No, USD, CHF. It's kind of bouncing around. It might be.
Oh yeah, I see. When this wick happened, that was probably hiccuped. Yeah, good call. I don't think we have the hiccup pattern on the UC. Yeah, let's keep an eye on that one. But everything's there. Everything. Well, let's see. Yeah, everything would be there. Contrary candle. So it comes back up. That GU gave up early, man. That kind of stinks. There was the flat, and it pulled back 7.4 already. Let's see if we can get another push up so we can finish that one strong. And the EU is giving up too.
There's a hiccup if it ends up that way.
Oh, yeah, there it is. There it is. 2 minutes, 43 seconds. Let's see what happens. Yeah.
So the hiccup is basically when the minors are going back up and the majors are doing something totally different.
They're not crossed, but they're.
Yeah, majors are hiccuping, right? So the hiccup pattern, so minors can hiccup too. So right here you can see minors hiccup, black down, gray up, not cross or touching, and then but they don't react the same way. Here majors oversold are hiccup, red down, green up, not crossed or touching. Simultaneously, the minors are crossed and they're touching the threshold or beyond. And green is on the short side because we're trying to sell. Oversold we sell, overbought we buy. So if we're oversold, we want green on bottom of red in pressure. Overbought, we want green on top of red in pressure. And then we want a contrary candle. If we're looking to sell, then we want to see a green candle. If we're looking to buy, we want to see a red candle. Oversold, we're selling, so we want to see a green candle.
So even though that's in the oversold area, you still go ahead on that thing and short it.
It's got a 90% accuracy for 5 pips, yeah. Yep.
I've only been doing this the last month, and I've done that on a few of those because it seemed pretty obvious, and it's worked
Awesome.
so far.
Yeah.
Out of pure ignorance.
Oh, that's, hey, you know what? Ignorance is bliss when it works, man. But that's awesome because you're identifying things within the indicators that sometimes take people a while to acclimate to. It's like learning a new language. Some people just learn it faster than others, and others, I didn't learn it fast. I just put a lot of hours in a short amount of time, a lot of hours. So that's, well, I just mean, so when somebody says, no, it's a good point. But when somebody says, how long have you been trading? And people will say, I've been trading for 10 years. Well, I would beg to argue that I probably put in more time doing it the right way, which matters, in the 5 years that I've been trading than somebody that's been trading for 10 years. That's how many hours I've obsessed over this. So the amount of days, months, weeks, and years I put in, whatever hours I could grasp at for a good year and a half, I took and I put to this. My wife used to call it my mistress. Now she trades. It's Utah. I'm allowed to have 2, right? Because you can laugh at that. I sent a possible trader down to the office tonight. His name is Clint, and he's a Trader Light webinar. Told him to find you before he left tonight. Awesome, Craig. That's, yeah, excellent. Tell him you can't miss me. I'm the only brown guy in a wheelchair around here.
Where do I add him to get to the TPG?
When he goes through the payment process, it should take him to a page where he fills out all the information, the alert. So daytradesmart.com/enroll. Did it take him to there?
He's in there. When I go to Slack, I see his name's in there. But he's in the light program.
Oh, to add him to the TPG channel. Oh, so here, I'll show you right here. So go to we'll go to TPG. So you click on here, invite new member to join, and then what's his name?
Gregory Strong.
Right there.
He wasn't on TPG.
Advanced.
Excuse me. He has advanced, so I must have put him in.
Oh, you have him in advanced already? You already added him there?
Yeah, because it's on his phone.
Oh, perfect. Yeah, because he didn't come up. So he's got TPG and advanced now. He's set.
So it should just automatically go.
Yep. Tell him not to chat in anything except for general. Yep, he's set. He's good to go. They'll show up now. Is he all paid up?
Yeah, but he said it is.
Okay. Keep an eye on it. All right. Yeah, I'll go easy, Brad.
Okay, so I'm signed up now.
Good. All right.
Went through. Good. I'm not sure if it's automatic or if I need to wait like a day or something like that.
Did it take you through a process that had you fill out the alerts disclaimer and all that stuff?
Uh-huh.
Oh, good. Okay. So the username and password that you use to register, you can use that to log in. And then actually, hey, Tim, we'll have to add them to the, we'll have to approve their permissions so that, I'll just do it real quick. So it's defaulted to trial. Okay. So now if he goes to daytrades, Gregory, if you go to daytradesmart.com, you'll have access to the full site. It defaults to just the trial, but now if you go, you'll be able to log in and have the full access. Ashley, do you need to make some announcements?
You always.
Awesome.
I was just waiting till.
I haven't seen you come up yet. You're not registered. So did it take you through? So it took you through the process where it had you fill out the disclaimer and press the enroll?
Yeah. I wonder if I did something wrong.
Let's have you go through. Oh,
So
sorry.
I'm actually on the Slack.
Okay,
So
perfect.
I'm in Slack,
Okay, let me do that first then.
but,
Hi guys, welcome to tonight's advanced meeting.
What did you
First of all, I
What did
just
you set
wanted
up
to throw
Slack
out
as?
there,
What name did you use
so
to
we
set up
have
Slack?
our
Did you use a
Reader's
username or
Think
anything?
Tank event that's going on next month.
put a username.
If you guys are interested in coming, please talk to your TOD about how you can
David Stringham, right?
to get to attend that. It's going to be Friday, May 11th.
Refresh.
Did I say 10th, Brian? Is that Friday, May 10th?
11th, I think.
11th? Oh yeah, so it's gonna be Friday, May 11th from 10 to 3. Hiram is actually gonna be one of our coaches that we're gonna have.
You should have
talk
access
in
to
there.
advanced
It's also going to have
TPG now.
Jason Hall,
My
Tyler
pleasure.
Oliverson, and Trent
As soon as I
Huddleston.
I don't
So
see your.
basically, I want to invite our advanced members to come and attend this. Basically, it's just going to be a forum. So you guys can come and ask them specific questions about trading, the indicators. You guys have like a strategy or something that you'd like to ask their opinions about, you're more than welcome to talk to them about that. So again, that's Friday, May 11th from 10 to 3. So I just wanted to announce that for you guys. Let's see.
10 at night to 3 in the morning.
Perfect. AM to PM. So Matt Parkin was actually supposed to teach
Let's
tonight,
do
but he
this.
couldn't
Let's
make
have
it,
you
so we
go
asked Hiram
through,
to fill
go
in
to
for him. So I'm going to go ahead
daytradesmart.com/enroll
and turn the time over to
and just go through the
Hiram.
process again.
And,
That would make
if
sure it
you
goes
guys do
through.
have any questions, please feel free to come and ask me. Or if you have questions about going live, that's me too. And then if there's anyone in here who hasn't had a chance to sign our member sign-in sheet, we do need you guys to sign in on this every week.
Red.
So it's important. So I'm gonna go ahead and pass
Red.
it around. And when you're done with it, if you just want to put it on the back table, then you can just do that. So, okay, your turn.
Thank you, Ashley. Appreciate it. Todd, do you want to say some things? Okay, awesome. Awesome. Thanks, Sugar. I'm on the wagon, man. I haven't had a drink since December. All right, welcome back, guys. For those of you guys that are just joining us, this is a Proving Ground review. Matt Parkin usually does this second half for the advanced meeting on Wednesday nights, and he had some issues, asked if I could fill in. Usually I only do this 2-hour session once a month, but Matt's my boy, so he needed some help, and so I was more than happy to help him out. Which means you guys are stuck with me for another hour. Okay, so we're talking about the hiccup pattern, and the reason why we call it a hiccup pattern is because it has a hiccup within it. But we coined that phrase a long time ago to explain what the lines within the majors and minors are doing. In this case, disagreeing, red down, green up, or if they're overbought, it would be red up, green down. And that is a hiccup. Now, hiccup pattern has 3 other elements. In addition to the majors hiccuping oversold or overbought, minors crossed and touching the threshold, short-term bias to the short side, which is another thing that we kind of coined. When we say short-term bias to the short side in terms of pressure, that means that green is on bottom of red. If it's long-term, if it's short-term bias to the long side, green's on top. So short-term, so small term. So if they're pointed down, then that's long-term bias to the sell side. And if they're pointed up, then it's long-term bias to the buy side. But it also works in cycles. So at some point, like everything, it changes. So you have to know where you are within that cycle sometimes in terms of pressure. Yes, sir.
So with this particular signal position with the pressure lines, is this indicative that it's going to trend towards the long side?
This is actually going to short. So this is kind of a bonus in this particular instance that they're pointed down, but it's not even necessary. Matter of fact, we have hiccup patterns happen where where pressure is pointed up like this and green's on bottom. And we'll still short that for 5 and get it 90+% of the time. So we'll look at the other example, which was overbought. And that, of course, we're going to buy. Here is they're not as aggressive pointing up, right? So I want to show you guys a head fake because hiccups and head fakes are so similar, especially in terms of the variables. Actually, 2 of the variables are exactly the same. And they have the same follow-ups. And they have the same value, pip value. A head fake is just more, it's more convincing. And I'll show you why. Convincing to minors. So here's a head fake. Now, a head fake it starts the first element, and which is important. It's important which element you identify first. So these elements are like red flags. Anytime we talk about elements or variables within patterns, they're the red flags. So when one red flag goes off, it says, hey, pay attention. Now that I've got your attention, look to see if the other variables, the other red flags are there. And if they are, and they remain that way till the end of the hour, at the very beginning of the next hour, take the trade. Okay? So the variable here, the first red flag that we identify is minors have crossed and entered the channel or beyond. Not just touch the threshold, but they have to be extended above this red line. You can see the end of the gray and the end of the black are above the red line, no question about it, right? They're not kind of leaning on it a little bit. They're obviously above the red line. So they have to be there or beyond. Meanwhile, the majors have to be crossed and set back. So look at this separation between major and minor right here. Minors have taken the bait. They're thinking it's time to buy. And majors even crossed up a little bit to give them that notion, right? So they released enough sells that it actually looks like they're going to start going the opposite direction. But you can tell it's not the case because it's kind of a lazy cross, right? It's not very aggressive, and they're hanging back. They haven't extended forward and up into the channel or beyond, so they're kind of just hanging back. Our third variable is the same as with the HICCUP pattern. Green is below red. Notice here it's neither pointing up or down. It's sideways, right? Which, by the way, the pressure indicator is not a trend indicator. It's a pressure indicator. It indicates trend, but it's not a trend indicator. What's interesting about this particular setup is that pressure indicator is indicating which direction right now, up, down, or sideways. Sideways, right? What is the market doing? Sideways. Red, green, it's sideways. Now, it's been sideways, so if we see red, green, probably red, right? Obviously, we're not going to base our analysis on that, but it's helpful. It's just kind of another form of validation. So we do have our third variable, which is green on bottom, and we have a contrary candle. We're looking to sell right here, which, by the way, this is one of our other flagship because our members were thinking the same thing. It's oversold. They're crossed up. I should buy. And we're like, well, normally, but that's not what it's telling you to do. It's kind of like, and I always use this analogy, so you guys can feel like it's a broken record for some of you, but it's like learning a different language, and you learn one word in a foreign language, and then later you hear that word used, you hear another word that sounds like that word, right? So you think to yourself, well, it must mean the same thing or similar. And then you find out later that it actually means the opposite. Well, it's kind of the same thing. We're looking at this, and it looks similar to what when we're young in trading and with these indicators, we think means one thing. In this case, we would think, okay, oversold, crossed and pointed up, we buy. But in this particular instance, because of these small nuances, we would actually want to sell. So here we're going to sell for 5 pips. This one also used to be 10 pips. But here's the thing: is that it has the same follow-ups. If these cross and point down after this and they're oversold, then while they're pointed down, we're going to buy on the next candle. And then after that, we usually get a double cross up, and then we're going to buy again. So the first thing we're going to do is we're going to sell. And then after we sell, we're going to look to see if we have our follow-up signals to buy. And then after that buy, we're going to look to our next to see if we could buy again.
So it's almost 15.
It's going to be 11. It used to be 10, 3, and 3, but now it's 8 or 5, 3, and 3. Yeah. So 5 short.
Is this the 60-minute chart?
That's correct. These are all on the 60-minute. All of our patterns for the mastermind are 60-minute and 1 day. The only exception is Jacob's Ladder, where we have a weekly, a 1 day, a 240-minute, and the option to position with a 60-minute. It's a little more in depth. But we're actually, oh man, I can't even talk about that. All right, I'm just going to, for those of you guys that are mastermind members, tune in next week on Tuesday, because we're going to roll out a new pattern. And right now it crossed the threshold, so it's looking really solid for it. Actually passed the threshold, so we're going to give it to our ninjas, and they're going to back test it. But usually passing the threshold, we limp by like 80 or 90%. You know, sometimes we're lucky and it's like 90.5% accurate, which one loser in that drops you below 90%. So we're kind of like gritting our teeth and hoping that after we front test that we're good. This one came in at 96%. So we are golden. I know it's almost 5 pips. It's a 5 pip trade, and it happens like 3 or 4 times a day on just one currency pair. So if you mix in, we're going to test it on multiple currency pairs to see what we can do. But it's beautiful. Tim actually found it. And so I'll let him roll that out. So we'll be talking about that one. Not tonight. We don't talk about new patterns in the Proving Ground review, so we save that for the mastermind. But I'm excited about it because I'm sitting there, I'm geeking out over it as I'm like back testing it the old-fashioned way. And Tim's like, yeah, I get it. It's good. Yeah, okay. And I'm like, dude, this is awesome. Oh, dude, all this thing does is win, right? And then you start singing. And anyway, so it's not. This one's not mine. I can't take this one. I can't take credit for this one. The other one's not looking like what was the? It was like high C 2030 or something like that. I can't remember. Anyway, but so here we took the short, right? And so what happens, similar to what happened with the hiccup pattern after the fake out, right? The head fake and the hiccup pattern are fake outs. And so you see that the minors are crossed here and pointed down, and also the majors are pointed down and crossed. The minors didn't get the sense to sell and then start selling. They broke their back. So think about if you have the average in the market. I'm not making these numbers up. I actually had an article that I found from Investopia. I'm not going to pull it up right now, but it was like traders traded a 50% win rate. That's the average. And 90+% of, or 80 something percent of professional day traders lose money. That's the statistic. The odds are vastly stacked against you. Not here. In this organization, that's not the case. We have stats to prove it. But if you're at, let's just give them the benefit of the doubt, 60% win rate. Okay. There is 60% win rate. And they're taking just, let's just say, you know, a 10 pip trade. Mind you guys, we took a 5 pip, and every candle there before, that's 8.6 from top to bottom. The body is only 2.9. From open to high is 5, and from open to low is 3.6. So if we took the trade at the post on any one of these candles, except for that one, if we took a buy there, we would have got that just barely, 6.3 with spread. If we took a buy here, we would have missed. If we took a sell here, we would have missed. If we took a buy here, we would have missed for 5. And if we took a sell here, we would have missed for 5. The only place we could have got our 5 pip trade out of these 4 hours right here was this candle, and it was short, not long. And we knew where it was coming, and we took it. After that happened, so if you're at 60% win rate and you are trading for, let's just say, 10 pips, right? Or 5 pips like we were doing. You're trading for 5 pips. And you have, so you have 6 out of 10 trades win for 5 pips. So 6 times 5 is 30, right? That means that 4 out of 10 trades would have to be, what's that?
Less than 30.
Well, actually, yeah, less. Yeah, it would have to be. So each of these losers
Have to be 5 or so.
yeah, what's let's yeah, 7.3 or something, right? So let's just say, because 7 pips, you're losing money.
28, yeah.
So they would have to be a 6 pip stop. Let's say 6, because that'll put us at a negative 24, which would break us even, because if each of these trades were traded at a 0.1, this costs us $6, right? Because it's 60 cents per 0.1 times 10, so it's $6. Negative 24 plus negative 6 is negative 30. Positive 30 and negative 30 equal each other out. You got a big fat donut hole, right? You make nothing, nada. So suffices to say that if they're trading long here with a 60% win rate, giving them the benefit of the doubt, their stop is pretty tight. It has to be, otherwise the math doesn't work out. And if they're successful at trading, then they're using this math. Okay? So if they have a 6 pip stop, they're getting stopped. Grr. Right here. So what happens right there? They didn't sell. They broke their backs. They were buying, and they got stopped out. And when they got stopped out, their backs broke. So the sells that were the buys that were in the market that were causing the miners to point up are gone now. And so the indication then becomes short. It's not because they wised up and shorted. It's because the majors broke their backs, right? So here, if you notice, we're already oversold, almost all the way oversold there. Oversold, almost there. So now 3 hours majors being oversold. There's nowhere else to go to the short side. So they still want to sell. So they got to get the miners to buy. Miners buy. Majors say, thank you very much. I'll take that. And miners break their back. Now, major and minor are both vastly oversold. There's nowhere else to go except up. That's why this works. And the beauty of it is no one else but you guys can see this. These indicators aren't available to anyone unless they're part of our organization. Yes, sir.
How do we keep from getting stopped out by market makers, by the majors?
You'll never, probably never have an account large enough to even worry about getting sandboxed by the majors. Small institutions that are trading, small investors that are like not prop firms, but like private equity firms and things like that. They're trading for large families. Like I was working with some equities traders about 6 months ago, and they were trading $1 billion of one family's money. It was called the Hunwell family. They were trading $1 billion of that family's money. They don't have enough pull to even move the market with $1 billion leveraged in the market. $1 billion. So you're going to hopefully you're going to diversify long before $1 billion you got sitting in a trade account. Yes.
Don't the majors go hunting for stop loss?
The majors go hunting for common stop losses. So they're not saying, hey, there's a guy right there, let's take a stop loss. They're saying there's a whole pile of people right there, let's hit those stop losses. That's why we don't use a lot of disciplines that are common in the market, because then you're just a bunch of sheep being led to the slaughter. You're ducks in a barrel, and you're all grouped together. It's easy. It's easy, slim picking. It's easy target, right? So yes.
Also, with that being said, will you see that behavior demonstrated in the indicators, like the black and gray tend to follow the green and red?
No, the black and gray. So the gray and black do their best to try to follow the majors, right? And they're basing their direction on the information and the education they've been given, which is biased, right? The information that's given to them is given to them by the very person that's going to take their money. So you got to kind of take it with a grain of salt. That's not to say that you can't be successful at trading anywhere else but here, because it's not true. I know other traders that have never traded with us and are very successful at day trading. Their win rates are lower, but they know how to protect their drawdown better than I do. And I don't have to worry about that. I'm sure they could teach me, and if I felt like I needed to, I could learn it, but I don't need to. I do a pretty good job of managing my drawdown as it is. I can afford for a trade to go 10 pips against me, 15 pips against me, and then come back. Because I play in high volume time, sometimes that happens within 5 minutes. I don't care. Fine, go against me 15 pips, come back, give me my 10 pips, and I'm out. I'm good. Right? They can't. Because even if it happens in a second and then comes back, based on their win rate, if it happens in that second and doesn't come back and continues, then they've broken their formula for success. So they have to be good at making sure that they're picking, where the market is just completely exhausted, which means that they trade very many more hours than I do, because they have a lot of technical and fundamental analysis to analyze, where I have my indicators. So I throw up shoddy support and resistance and read my indication, place a trade with a 96% win rate. Yes, sir.
Your example, your stop loss was what, 6 pips?
For them, yeah. I mean, if you do the math, it'd have to be.
Aren't most people going to know that and put their stop losses in that area?
It's 6 pips. Yeah, if the majors know that, they'll see it, and so then they'll pick up those stops, and that'll cause for the market to continue in their direction, and they'll make that movement that they need, and they'll make that profit. I'm not going to use a 6 pip stop, right? I'm going to use support and resistance to justify my stop, and then I'm going to work backwards. So I'm going to pick my stop. I know my win rate, so it's the calculator, right? I'm going to work backwards than they do because I can justify it with my win rate. So if I've got $5,000 account, for example, and my win rate, let's just say 85%, and my stop loss is 25 pips away, or potential hedge position, then I'm going to trade at a lot size of 0.4, and I have to take a minimum 6.3 pips profit. Otherwise, the math doesn't work out. It doesn't. So can I take a 3 pip scalp? No. Can I take a 5 pip scalp? No. Because I'll lose money with anything else unless I have a minimum right here, which I can increase. I can take more than 6.3 pips, but I can't take less. Otherwise, I break the math. It's not because I said so. It's just how math works, right? My lot size, I cannot increase my lot size because then I'd be risking more of my account than I can justify, and that's a recipe for failure. So, but I can decrease it. So if I feel like it's still a pretty risky trade, that I'm not ultra confident in it, then I can decrease my lot size, but I cannot increase it. I can increase my minimum take profit, but I cannot decrease it. That's how I designed this calculator, is to account for all the math and a buffer. So if I did 86%, you're still going to risk 2% and nothing's going to change. 87%, now you're going to see a change. So from 84 to 86%, nothing's going to change. You're going to risk 2%, and with the stop loss of 25 and a $5,000 account, it's going to be a 0.4 lot size and 6.3 trade minimum. At 87%, it changes. So why not change with every percent? Well, because with every percent you improve, the more profit you make. Instead of continuing to carry the risk over, you're just carrying over the additional win, which results in additional profit without having to necessarily carry over the risk. So that's why I have a range: 80 to 83%, 84 to 86%, 87 to 89%, and then 90+%. Anything that's below 70%, if you guys have ever used my calculator, you'll notice that it says, so at 69%, it'll say, do not trade. Say lot size, no, it's nullified. It says just don't trade. Pick up your win rate. You can use a 69%, but it's a challenge. I want people to be able to get their win rate up a little bit. You can do it. It's simple. And if you're not doing it, it's because you're overcomplicating it, usually. Okay. A little off track, but do they monitor take profits like they do stop loss to manage the market? They take profits are going to work the same way. So if you have a whole bunch of people selling and you want to continue to sell, then you got to get them to either buy or get out of their sell positions, because again, two things make the market move. Buying and getting out of sell positions make it move up, and selling and getting out of buy positions make it move down. So if there's a take profit that is a sell and they want to continue to sell, but there's also stops within there, then it benefits them equally to hit the take profit for some and the stop losses for others, because that's going to alleviate that weight to the short side and give them room to continue to short. All right. So here, again, it seems counterintuitive because these are pointed down. Pressure is even pointed down. Look at that. We got a big red candle that broke out of this consolidation. But what are we going to do here? We're going to buy. We know that, 60, 70%, which is most of the time, this is going to sell a little bit still. But 90+% of the time, you're going to buy for at least 3 pips. So we're going to stack the odds in our favor. We're going to buy instead. And so what happens? Yes, we sell, but we also buy, and we get our trade. So we're out of that trade. Now we got, look at this. Again, we get the double cross, just like we got before. So we take that up again for 3 more pips. And that one moved 22.3. And if you guys see something that's a reoccurring theme, and that's that we're getting, a lot of times we're getting more than the 5, 3, and 3 in terms of pip value. 90+% of the time is difficult to do anything larger than those. So we're saying 90+% of the time, you're going to get these. But if you're instituting other disciplines, you can take more than what we recommend. And I was sharing this earlier about a couple of our members that are taking, I had one guy took a flat top for 175 pips. That's a 3-pip trade. It comes in the alert and it says, it's, I can't remember the verbiage. So it's just, like this one, USD JPY flat top, have exit strategy, or long 3 pips, have an exit strategy, evaluate on post. So 3 pips, right? And he took 175 pips. We have guys that are they're not taking every single one of them, but they're waiting for the perfect setup. They're instituting other disciplines, support, resistance, pivot points, channels, trend, all that stuff. And they're bringing it all together, and then they're executing and they're getting better results. Are they missing opportunities in some of them? Yeah, they are, but it's 3 pips. Meanwhile, they're taking 30, in one flat top. Did that UJ work out, by the way? Who is monitoring that? Let's look into it. That GU did. There's the GBP USD flat overbought. It just barely finished overbought. Man, that was rough. And yep, that one filled. And let's see, what was the other one? UJ, yeah, okay. USD JPY. Where?
That was my thought too. That was the Euro USD.
Euro USD was fine. There's overbought, flat, short it, and 5.3. Yeah, we got that one too. I didn't see any UJ flat. 6:52. What time is it? 7:30. So that would have been a 7 o'clock post. 6:52. UJ. What are you, high? There's nothing there. Oh, yeah, there it is. Watch this. Look at this magic. I'm like, what sorcery is this? Oh, that's too fast. Okay. Did it all? It's already still going at 200. Dang it. It already happened. Hold on. Just stop. Redo it. Okay. Oh, so much. I've never done it before, but sure, why not?
Yeah, all right.
Yeah, sure, why
This
not?
one time for me.
Yeah, just this one time.
Okay. We're good. Call your mom. He'll do it.
Call your mommy, Brett. I got your back.
Sure.
Yeah.
I told Matt I'd do it, but I need to write home.
Yeah.
I never done it before, so they're in for a treat. Hey guys, I'm doing the Aussie Impact trade today.
I'm not sure it's a great idea, but okay. So my week.
Are you sure?
Yeah.
Okay. I appreciate it.
Yeah.
I'll tell Candace that I owe you guys.
All right.
I owe you.
Okay. I'm gonna hold you to that.
Thank you.
You got it. So we're waiting for the flat, right? I'm gonna go 5 times the speed here. Let's go 20 times the speed, 25 times the speed. So we're oversold, negative 97, and we need to see that negative 100, and we have to actually see it with 15 minutes remaining. So we got to see it at the 15 here and the 45 right here. So let's wait till we get there. Let's kick this up a little bit. 100 sounds good. Okay. Oh, there it is. See it? Negative 100, oversold, and then it pulled back. See what happens again within that 15-minute block. Come on. So here's the 15-minute block right here. Yeah, sure enough. There it is. You guys see it? That's where it would have triggered. And then before the hour was up, it reversed and it did its thing. Okay. I'm not going to cry about that one anymore. All right. So that was, well, we're 2 for 2 for the ones that posted. So that was good. Okay. Back to the head fake. Another head fake right here. So again, minors crossed and entered the channel. You can see they're completely extended beyond the threshold and or above. Majors are hanging back. So you can see that separation between major and minor. They kind of got a lazy cross, but they are crossed up. So that's our second element. Third element, green is on bottom. You see they're not pointed up or down again. So again, it's not necessary that they point up or down. And then we've got a contrary candle, 60-minute green. And so we've got, we're looking to sell. So right here, we're going to take a short for 5 pips. Let me erase all my drawings here. And there's our short, 36.1 pips. Again, look at this. Deja vu. It looks exactly the same. That's why it's called a pattern, just in case you're wondering. So we're going to buy. Again, 60 to 70% of the time, which is the majority of the time, this is going to sell. But we don't want to trade at a 60 to 7% win rate. So we're not going to sell with it. We're going to buy because we know 90+% of the time it's going to buy for at least 3 pips. And good thing, because that went 1.7 pips, which isn't even enough to get 2 pips of profit. And then it turned around and went 39 pips in our favor and settled about 31.8 pips up. So we would have been eating dust had we shorted there, right? Saying to ourselves, well, the last couple of times, you know, it gave us a little bit to the short side. Let's just try to take some of that profit. And that's when it'll cost you, when you break your rule. Speaking from experience. And here's the double cross again, like we saw in the previous examples. So that would justify taking another buy for 3 pips. And that moved. We took a sell. Yeah, we took a sell. When this posted, the end of this candle, the very beginning of the next, we sold for 5. And then here, because these are pointed down, after the head fake, we bought, which seems counterintuitive, but we know what we're doing. And then here, because we got the cross, which is the follow-up after the reversal, then we bought for another 3. So 5, 3, and 3. And that one moved 20.7 pips, settled about 7.1, and a total of 38.9 had you shorted at the end of that candle. Yes, ma'am.
So all of these moves happen at the top of the following hour. Is that correct?
At the top of the hour. So the post happens, whatever the pattern, if the pattern remained up until the last second of the post, then that's your cue to hit the buy or sell button at the very beginning of the next, regardless of what the indicators look like at the beginning of the following candle. So it's however remained on the previous, and then you're gonna use that to execute. Here's another head fake, or sorry, hiccup. So this is the hiccup pattern. Again, green down, red up, overbought. Miners here are actually crossed and entered the channel. Green pressure is on top. They're not pointed up. They're almost kind of slanted down, and we have red contrary candle. All 4 elements are there. What do we do? You guys could do. All right, there we go. I'm hard of hearing sometimes. There we go. Buy for 5. So there's our 5. A little bit of drawdown, 3.9, but we got 8.5 to the long side. So we got our 5. Are we selling? Yes, no, maybe so. That's right. Not until majors and minors both crossed and pointed up. Majors are up. Minors are not. Here's the caveat that I wanted to point out. majors cannot leave the overbought before minors cross and point up. Otherwise, your follow-up is nullified. So if minors kind of hang out underneath down here, and majors start to cross down and enter the channel and post that way, your follow-up's nullified. They have to both point up, and then at the post, after they both point up and they post that way, then you short. And then usually you get the double cross, and then you short again. Okay? Now, right here, we don't see the double cross that we need to, or the point, both of them pointing up like we need to see. So we're going to wait. Majors are pointed up, minors are down. Still no follow-up. Majors are down, minors are up. Still no follow-up. Majors did not leave the overbought. Majors are up, minors are down. Still no agreements to the long side. What about now? There it is, right? So right there, majors up, minors up, so we short. 3 pips. Ta-da. Look at that. Which is just incredible because we went, how many candles? 1, 2, 3, 4, 5 up. And we know something everyone else doesn't. Now we're going to short. Okay. Let's look at those duck bills. Now that we understand a hiccup, we'll look at those duck bills that we looked at earlier. Oh, we got a Euro US flat, double flat. Nice. There's another flat right there. 18 minutes and 1 second. So in about 3 minutes, you'll get the alert for it, guys. Those of you that are getting alerted. If this GU pushes up a little bit, that line may very well flatten out again and give us another trigger there as well. You see it's done. You see that, how it posted like this, angled up? There's no way it's going to flat now. So that's done. That's another thing is you'll really quickly understand what comes natural to the indicators and what's unnatural. Once you can differentiate the two, you'll realize that, especially in back testing, when something unnatural happens, it's usually a result of something emotional happening in the market, whether it's an announcement or something abrupt happening globally that would affect that particular market or all markets in general. So let's look at those duck bills. So it was the USD JPY, and this is a one-day chart. You can see I just switched to a one-day chart, and Euro US, and I switched that to a one-day chart. So we have our hiccup right here. Not a hiccup pattern, even though that's pretty much what that is almost. What's missing out of this hiccup pattern if this was a 60-minute chart? Yeah, minors are not touching. Mind you that even when all variables are not present, majority of the time, they're still going to work out the way you think they should. Majority of the time. But that's not good enough. Majority of the time is not good enough. If you think about it, if you have 80%, let's say something happens 10 times in one day, and you have an 80% win rate, that means that 80%, 8 out of 10 of those are going to win, right? Now think about the currency pairs that we're trading in. We're trading in the Euro US dollar, right? The GBP US dollar, the USD JPY, the GBP, the Aussie CAD, and the GBP JPY. Okay, what did I leave out? USD Swiss franc. Okay, so think about that. When we get a Euro US alert, a lot of times you'll wake up and you'll notice that like 4 or 5 of them went off at 3 a.m. You know, 1 a.m. to 3 a.m. or whatever, right? So if you get 10 of those, not saying that you're going to get 10 of those, just do the math easy. If you're getting 10 of those and 5 or 6 of them are happening while you're sleeping, and those all won, and you're going to hit 80, let's just say 80%, then you know that within the next 4, you're going to have 2 losers, which gives you a 50% probability, right? just hypothetically speaking, that's not the way it works. That's not even how you can figure it out because we don't ever know how many we're going to get in a day. But just to give you an example, so it's imperative that we have a high win rate because that's going to give you the absolute best chance at getting a winner regardless of when you take it. Besides that, it's impossible to get 100%. Although I do have one pattern that from 2014 to current, it has not lost once for a 30 pip trade, but it's happened 3 times. So, you know, if you want to make 90 pips and it's going to take you 4 years, have at it. So that's why I haven't rolled it out because it's virtually useless. I think we have it as an alert. It just never alerts. Try us next year. And eventually it's probably going to lose. It just doesn't happen often enough. So it may very well lose. It just hasn't happened yet. Yeah, thanks, Brad. Touching minors, that's right. So we need to have that high win rate. And so when we say it happens most of the time, that should not be appealing to you. So even though a hiccup pattern on a 1 day, most of the time is still going to short, it's not 90%. And when it doesn't short, it eats your lunch. So you can take the risk, but you probably want to have other disciplines to justify taking something like that. Or a hiccup pattern that does not have all 4 variables present. It's still majority of the time going to work out, but not at a 90+% accuracy. And if all you're using is a pattern and no other discipline, then you probably want to give yourself the best odds possible, right? Okay, so the follow-up, however, so check this out. The follow-up to the hiccup and the head fake have nothing to do with the other variables. All that's necessary is that you have this sort of hiccup pattern on the previous post and then both major and minor pointing down thereafter, or if they're overbought, up thereafter. Even if you don't get all elements within the hiccup pattern, but the majority of the time the follow-up still happens where they're both pointed down, that's still a 90+% buy, even though you didn't take the previous because all the variables weren't there. Because now they're both pointed down, major, minor pointed down after what looked like a hiccup or head fake, you're still in the 90s to take a 3-pip buy. And then usually the follow-up is going to be a double cross, and you can take that as well. So don't get discouraged if the first trade doesn't work out, but then you see the follow-up set up. Because the follow-up, the variables are not pressure, not contrary candle. You know, it doesn't have anything to do with whether the minors touch the threshold or not. All that matters is that the majors faked out the minors, and now they're both pointed down, and they're vastly oversold again, right? There's nowhere else to go in the market. And so that in and of itself is going to cause for retracement up. And if it's less than 3 pips, it's not worth taking the trade. And because of spread, we have to make sure we compensate for that. So after we've done all that, we still walk out with a 90+% accurate trade to the long side. So no surprise that this right here, majors pointed down, minor. Look at this. This is a hiccup on the 1 day. This happened day before yesterday, Monday's post at 3 o'clock. Here's Tuesday's post. What's tonight? Wednesday? So sorry, that's Tuesday at 3. Here's today at 3. And it did the same thing, right? Majors pointed down, minors pointed down, even pressure is down. It's not a day pattern, so don't try to use it on the day. It's a 60-minute pattern. Because 60 to 70% of the time it draws down, the drawdown you can't outweigh with what you can get 90+% of the time with profit. So when this happens on the 1 day, I can still get, 10 pips off of this, 3, 5, 10 pips off of this pretty easily. But sometimes the drawdown is beyond 50 pips before so it leaves that shadow and comes back and gives us a big candle usually. But there's no way to offset what the drawdown could potentially be for the profit. So sometimes it's not even that I can hit it 90% of the time. It's that there's too much drawdown in that process. And so that's what drops us below that 90% accuracy because we can't break the math as much as we want to sometimes. We want to say, well, let's just take it because it's going to work out regardless and just suffer the drawdown. All it takes is the one time that it doesn't work out and it eats your lunch, you're already in big trouble because you're suffering the drawdown. So if you have a 50 pip stop loss, for example, or let's say you have a 20 pip stop loss and you remove that 20 pip stop loss because you're like, oh, the market's going to come back. I can already see it. And I don't want it to stop me out of 20 pips because I know it's going to come back. So you remove your stop loss. And then all at once it drops another 30 pips. Now you're 50 pips upside down in no man's land. And you're saying to yourself, oh, what should I do? Okay, now it's got to come back, right? And then you start looking at a 1 minute and 5 minute and praying to Jesus that it starts coming back, right? And then when praying to Jesus doesn't work, you start praying to John the Baptist and Mary and everyone else, right? So when all that doesn't work and you burn your account, you realize the error in your ways and you should have just stuck to your exit method. So we don't try to justify one with the other when the same thing happens with alerts. And so if the drawdown is too much, we're not going to say, even if 100% of the time, despite the drawdown, it came back and would have given us our pips, even if the math didn't work out, but 100% of the time it worked out for 10 years, we wouldn't do it because it's a bad habit to have. And if we start making allocations there, then it's going to spill over into other facets of our trading. And it's like all it needs is just a crack in the door to get in, and all of a sudden there goes the neighborhood. So you don't want that mess. All right, so here we did get our duck bill, and as a result of duck bill, obviously we saw that we got our long move. This candle is only 5 hours old, so but it's moved 16.8 pips since the close of day, and it only moved about 0.7, which is less than a pip against us. So it's a pretty solid trade. Nothing to cry about. Yeah, sure. And the UJ has done pretty much the same. It went four pips against and then moved 18.5 pips in favor. So those are both clean trades. So the duck bill starts off with a hiccup, not a hiccup pattern. So this is not relevant. This is not relevant. This is not relevant. It's just that the majors are hiccuping, oversold or overbought. That's kind of how it starts, right? Green up, red down, not crossed or touching. And then on the next day, so that's not the trigger. You do nothing there. Matter of fact, you're not even looking at that until the next day, and this happens, where you got that bill, right? So it kind of looks like this. Like we call it a duck bill because it looks like a duck bill, right? There's your duck's head, and then there's the bill, right? The quacker. That's upside down, of course. If it was overbought, then the duck bill would look like this. One day when I die, you guys are going to sell these paintings for lots of money. There's your duck, right? So when that happens on a one-day chart and it posts this way, we short or we go long. And we actually had both of those happen on two different currency pairs today. At 3 o'clock, we had the euro versus US dollar on the one-day post duck bill. So there's the duck bill, right? What I just drew. There's the eyeball. Now you see it. Now it's clear. So the eyeball made it all clear. And so we went long for 10 pips. And our trade, our entry was right there. We entered there and we got out there. A little bit of drawdown, not much, and then we took profit. On the
that was based on where it closed on the day.
I actually put it in early. So normally I'll sacrifice swap fee, carrying a trade from past. You get into a trade before 3 o'clock and you carry it past 3 o'clock, you get a swap fee. And normally they're not very much. So at 3 o'clock, your spread usually increases. And so if you get in before that, then you get in with low spread. And then as it opens, then the spread increases. And so a lot of times for me, I like to get out of my trades quickly. So I'd rather sacrifice, take a little hit on the swap and then get out of the trade early because the decrease in spread. But I forgot that today was Wednesday because I'm a newbie. So on Wednesdays, for those of you that don't know, is 3 times the swap. If you're ever curious as to information on any of that, click on any currency pair. So right here, Euro USD, and then go to, that's what I said, the specifications. And if you go down to, in this case, we'd go down to swap long, -362, swap short, -4. The short swaps are less, but it used to be that they paid us to carry over short trades. So you'd get paid on the swap. And some brokers still do that. Ours just doesn't. 3 days swap, Wednesday. See that right there? Yep, that's what happened to Hiram today. So there was the 3-day swap right there, which was about 10% of my total take profit. So it's not like, it's not, mind you, this is a demo account and it was only a 0.4 trade. So I made a whopping $40. But then I got gouged 10%. Who wants to get gouged 10%? It's ridiculous. Same thing happened, or less happened on the UJ, because I only got dinged about, 2.5%, 3%. But in addition to that, UJ, the profit's different, so I only got 36.59, and it's probably because the spread increased as it crossed profit. But you can see.
So had you waited put in after the hour, then you wouldn't have to pay that.
I wouldn't have had to pay that, but then I would have had a larger spread. And fortunately, today the spread wasn't too bad, but sometimes it can get pretty ridiculous, especially on the UJ, but USD/JPY. But the USD/JPY was 2.2 and the Euro US was 2.1 after 3 o'clock. And so they weren't bad. But sometimes you can see it be double that. And so instead of having to just get 10 pips, I would have had to get like 14 or 15 pips on the USD/JPY. And then the Euro US, I would have had to get, 12 or 13 pips. So, I don't want to wait around all that time. I want to get out quickly. And so I usually just suck it up and take the swap, take the hit in the swap, and I'm good. But today it was 3 times the swap, and I forgot about that. So anyway, there's the profit on the USD/JPY. Open there. Look at that, though. It took like 3.5 hours. Kind of dumb. We took 20 pips on 2 trades and took about 3.5 hours. They both filled in the same hour. That's 3.5 hours. I don't know about you guys. I don't like that stuff.
What happens if you end up in a trade and it's prolonged and it's on a Friday? It's 3 o'clock.
That's a difficult question. So I'll tell you what I would do. What I would do is hedge it and just call it a loser and just hedge it. Because if for some crazy reason something happens over the weekend and it affects the market, you're going to get huge gaps. Something similar happened last year or the year before last, where French elections happened, and it was a standoff between Macron and Le Pen in France. And Le Pen was geared to win, and Macron came from behind and just he was able to take the win. Le Pen was, I want to say, if I recall, she was pro-Frexit, right? French exit from the euro, and Macron was not. He was more like capitalism and let's stick with the euro. He's good with corruption, so he's going to hang out. But so the euro gained strength after the polls came out. Well, that was before the market opened, and so it opened up like 100 pip difference. So people that were short, they were in serious trouble. But other stuff can happen. Terrorist attacks. Who's to say the terrorists don't work on Saturdays, right? So stuff like that, you never know. So I always just protect my tail. Either close it or hedge it. I'm good at getting out of hedges with a price average. And if I haven't reached my hedge position, mind you, my hedge position is like 20 pips away usually or less. So if I haven't reached a hedge position yet, I'm less than 20 pips away from my original position. I can make a 10 pip trade in my sleep. So if I hedge, let's just say 15 pips, I only need 7.5 pips to get out of a price average to break even. I can make a 7.5 pip trade easy. So I've already chalked it up as a loser, and I know on Sunday I'm just going to break even on it. 7.5 pips, I'll make some profit on it. I'll go just a bit beyond break even to cover my swaps and commissions, maybe make a little bit of profit so I feel good about myself, and then close the trades, and I'm done. So I'm not going to risk my whole account over one trade ever. Matter of fact, I'll never risk more than 5% of my account on one trade. I have a stop. I use a stop loss that nobody ever knows about, only because it's never been hit. But that doesn't mean that it won't ever be hit. It's there as like the doomsday worst case scenario, fire and brimstone type situation where you got a flash crash. Instead of killing my whole account and my life's work, just take your 50 pips and leave me alone. You know, but that's and it never gets hit. But again, it's not to say that it won't. All right, guys, I'm going to wrap up with that. I appreciate you guys hanging out with me tonight. Apparently, I'm going to do the Aussie Impact trade. So if you guys want to hang out for that, it might be interesting because I don't really like the Aussie pairs. So let's play. All right. Thanks, guys, for joining us, and have a good night.
All right. Hey, one more thing before everybody leaves. Many of you have met with me. I'm Todd Coleman. I'm in charge of the partner program here. So you probably wondered how we get the word out, right, for day trading. Well, our partners do that. And our partners are independent business owners with us. If you're interested in that program, I want to invite you May 11th